After the enhanced unemployment benefits expired and schools reopened in person, many expected workers to go back to work and the nation's labor shortage to ease significantly by September. But recent data suggested that, if anything, the shortage is getting what they call somewhat severe. And though the risk of severe shortage is going to continue until 2022, is not the most likely scenario, but the chances of it are increasing. And that means we could see significantly lower economic growth next year. A majority of small firms, 51%, which is 51%, say that they have job openings they're unable to fill. But according to a September survey by the National Federation of Independent Business, the Conference Board CEO Competence Survey revealed that the percentage of firms that are citing difficulty attracting qualified people jumped from 57% in the second quarter of 2021 to 74% in the third. And the ratio of job openings for hiring, a proxy for the average time to fill positions, is at a series high, according to the Bureau of Labor Statistics, as it is the rate at which workers voluntarily quit their jobs. A few factors are still limiting the supply of workers. Some people are delaying a return to the labor market because they still fear catching the virus and becoming ill. Definitely, basically. The federal mandate for large private employers to require workers to be vaccinated or tested weekly may be a new drag on labor supply, as some workers are not willing to get the vaccine. But what's more, the older Americans' labor participation rate, which measures the share of a population that is either employed or looking for work, it significantly declined during the pandemic, and there are no signs of it recovering, either because older workers are at a high risk of becoming extremely ill from catching the virus, or they feel financially prepared for retirement given the surge in stock and home prices in recent years. In addition, many working age Americans have become more selective in terms of the jobs they are willing to consider, or have decided to stop working altogether. Of course, how selective people can be depends on how long they can survive without a paycheck. And in the last 20 months, a significant share of households was able to increase their savings because of reduced spending, enhanced government support, and a large increase in home and stock prices, but these savings will not last forever. The most likely scenario is that many Americans will return to the labor market in the coming months, leading to some easing in labor shortages. With that being said, there is a significant chance that the dearth of the workers will continue in 2022. When businesses have difficulty recruiting and retaining workers, the wage acceleration follows. According to the September job reports, average hourly earnings increased at an annual rate of 6% over the past 6 months. That is more than double the average rate over the decade prior to the pandemic. And such wage acceleration will take a bite from corporate profits, and it may lead companies to raise prices. And what's more, not only did labor costs dramatically accelerate in 2021, but the inability to find workers impacted some companies' operations, and they contributed to lower profits, meeting demand for 3 million to 4 million more workers as the U.S. economy continues to reopen in 2022 with a major challenge. But the U.S. needs to find ways to raise the number of workers through larger and more economically motivated immigration policies and the higher labor force participation. For example, the federal government can make labor market needs for specific skills, which is a larger consideration in the immigration policy. And companies should attempt to hire more workers from demographic groups that typically participate less in the labor force. If we do not address these issues, a continuing labor shortage would pose a serious risk to the 2022 U.S. inflation and economic growth outlook. For the first wages for new hires will continue to rapidly grow. That, on top of an escalating cost of living, will increase wage growth for workers who stay in their jobs. Across the board, the higher annual raises and special adjustments to retain workers are likely to further increase companies' overall labor costs. Now, for the first time in decades, the scenario of a wage price spiral, where higher prices and rising wages feed each other, leading to faster growth in both, could actually hinder economic growth. In such an environment, the Federal Reserve will be forced to raise interest rates multiple times in 2022 and materially slow down the GDP growth by more than what is already currently being foretold. Without policymakers, business leaders, and thought leaders more clearly recognizing the current dangers that labor shortage poses, the U.S. risks not being able to fully recover economically from the pandemic for the next couple of years, if not more. But if you like the video, give the video a like and subscribe to my channel, RBW King, and also hit the notification bell so that you'll be notified when the new video comes out. And thanks for listening.